Welcome to another episode with Loans Elevated. My name is Broch Lassig, top 1% loan officer nationwide.
And I'm TJ Heidenreich. Together we bring the latest news, strategies, and insights in the mortgage and real estate industry.
That's right.
They're going to the Google machine. And the Google machine that they're typing in, we typed in just housing market. And this is what's being brought up. It's fear-driven from the start. Because media, they're getting paid off clicks. So sunshine and rainbows is not getting clicks, but fear-mongering, that's going to get them the clicks. So home prices just broke a decade-long streak. That's like leading you to, say that, gosh, home prices are falling drastically. Like it's a bubble.
And the reality, what should we be telling, what do our clients need to understand? Home prices finally stabilized so that the entire economy doesn't break with outrageous inflation. That's what they should hear, right? But it's this fear-mongering, scary-looking headline. So.
In fact, FHFA just came out and said we're up 5.5% year over year.
Yeah,
so it's like,
crazy.
give them the real facts rather than what's being stated. Housing market, overly sensitive with Fed rate hikes that we saw just last week. Well, if we're reaching out to clients, our clients know rates don't actually follow the Fed funds rate.
Well, they don't know that, but they're being led to believe they do.
Exactly. They're totally being led to believe they do. So we need to become the local real estate economists. We taught a class on this, gosh, last year, 6 months ago?
A year ago?
Yeah.
About a year ago.
Yeah, and how to take the data that media is giving us, distill it, and feed it to our clients in a way that's not going to drive fear and give them the actual facts. Dive into that.
Cool. So somebody that we follow heavily, and we are going to be teaching this class again, so we'll get invites out to everybody here. It was a really powerful class and something that I think takes a long time. We've invested years and years into doing it, so we hope to teach this on an ongoing basis. But we follow Barry Habib. He's a prolific guy in the housing industry, probably, in my opinion, the best. He knows how to distill it, and he's taught us basically everything we know. But he recently said to understand housing, which we all need to understand in our industries, you need to understand mortgage rates. And to understand mortgage rates, you have to understand inflation. And it's that simple. And this is the stuff that we need to understand to be able to coach our clients through navigating the fear that is developed from these headlines. So let's go next.
Yeah, for sure.
So inflation is the first thing. Or that's I guess, the biggest thing we need to understand. And we are all sick of it. It's been, again, deja vu. Every day it's like Groundhog Day. We wake up and it's like we hear inflation, we hear Fed rates, we hear all this crap, and we're so tired of it. Inflation's one of those things. Well, the beauty is we've done some research, and this comes from the Fed. We've done some research, and you notice since 2018, we are dramatically about 30% higher in retail inventories than we've been in years. What, 5 years?
Yeah.
We're at a massive peak. Now, at a previous market update, we talked about this happening because we've been harping on everybody that inflation, when that comes down, mortgage rates are going to come down. And what's going to happen? Our clients are now going to be back on the bandwagon, right? Buying again. And we want to coach our clients through this. Well, this is a sure sign that the things that are on the shelves of retailers that we all buy, the consumer staples, they are oversupplied now. What's going to happen? They're going to drop prices. Inflation is going to come down. Mortgage rates are going to come down. So this is a really good sign. Next. Now here's another major detail. This one's a little bit more complicated. The purple line is showing the apartment list rent year over year change. And we did apartment list and not something from the Fed, which is the data that we normally try to grab, is data that's not disputed, not infiltrated by some profit-making company, right? Because it's maybe a little less trustworthy. But this, unfortunately, the Fed doesn't give real-time rents. They give lagging data. What we're seeing in the purple line is real-time rent changes. And you see this massive spike in January 21, peaking around January 2022. Well, the blue line is the CPI. So this is the inflation data that the government is announcing, the news is publishing, and everybody's hearing. That's what the blue line is showing. And this is the housing component of it. But you notice it's extremely lagging. So right here, when it was peaking, it was still stable, right? We're kind of reading like these data points. So it's about a year behind. And if you notice, January 2023 is where we sit now, showing the inflation data. January 22 is when we saw things peak. So the expectation from inflation is that we're actually going to see this real-time data start rolling this trend over. And that will have a massive impact on inflation. And therefore the Fed's behavior. Yes, Rob.
What is CPI?
Oh, yeah, forgive me. Consumer Price Index. So that's the inflation reading for consumers. There's multiple readings. Consumer Price Index is the one that we follow most closely. And the Fed follows extremely close. In this reading, shelter, which is what we're showing here, is 43% of the reading. So let's say that the Fed was taking into account real-time data on rents. It's worth by far the biggest component of this inflation report, which is what's guiding these mortgage rates. If it was real-time data, inflation would be 3.5% annualized, not 5.5. The Fed's target is 2. So that means they've met all of their objectives when it hits 2. That gets us much closer. And that's as of right now with where things are at. So as we see this roll over, the retail inventories start to dive in and start driving that inflation even beyond just the housing data. This is all good news. Does that make sense? It's kind of a mouthful, but it's really important to understand. Yeah, any questions? Tony? You're good. Okay, Tony. Cool.
If you guys have heard us talk on social media about May 10th, I mean, we've said it over and over again, but May 10th is when we're going to get a report that's going to show that shelter costs are coming back in our favor and rates should follow suit.
Yeah, which at the end of this, we're kind of going to hopefully make this a little more clear.
Yeah.
But why is this all important? Again, we've said it time and time again. Deja vu is what we keep saying. Mortgage rates will follow inflation. And we see here the blue line. This is from the Fed. This is all the way from like 1965 through to today. And you notice that what we're saying, we're not just saying mortgage rates follow inflation. We can prove it with data that is tracked by the Fed. You see if the lines go up, so if inflation goes up, which is the blue line, you notice mortgage rates go up in the 70s, in the 80s, in the 90s, in the 2000s. Like it's almost a mirror image, the graph. What we're noticing is inflation convincingly rolling over. It's not just like down a little bit, it's down a lot. And mortgage rates have just started that decline. So we are definitely expecting a massive decline in mortgage rates. Now, that's not all rainbows and butterflies, which we're going to get into, because we're seeing how scary that can be from a supply and demand perspective, which we're going to speak to. But our clients need to understand this. Like we've talked, some things for our clients that they've heard is marry the house, date the rate. And a lot of these things have become very dull to the consumer and even to us as industry participants. Like we cannot underscore this stuff there's nothing more important than helping our clients really understand the gravity of some of these marketing coined phrases because it's so important. And many of these first-time buyers that decided to not listen to it, thought it was something gimmicky, are unfortunately already today starting to get priced out of the market. So we just need to be cautious of that. But anyway, moving on.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.